Welcome to Whole Life Insurance Mechanics from the perspective of Nelson Nash's infinite banking concept. I'm Ryan Griggs, your host and lecturer. This is part 5 of our 7-part series, and our subject today is direct and non-direct recognition. Here's our overview. We'll start with definitions of what it means for a policy to receive direct recognition treatment, and also what it means for a policy to receive non-direct recognition treatment. To understand my point of view on which one I prefer, we're going to get into the economics of what a dividend is as opposed to what interest is, or what compensation for ownership is as opposed to what the price of credit is. And that'll be helpful to understand my view, but then, of course, you can take that out there and contrast it with what others might tell you. I do want to be as charitable as possible. I mean, I want to anticipate some objections, so we'll go into what the 3 main rationalizations are for the use of direct recognition treated policies. These are the 3 that I'm familiar with, that I've seen online, on other YouTube videos, on articles. Of course, we're not going to name names or anything. It's not about that. Just sticking to the ideas here. One of those 3 rationalizations involves what's called a cash value line of credit. This will be abbreviated CVLOC. Other banks call them different things. Can't think of the names off the top of my head, but anything involving the accessing of a line of credit from a commercial bank using a policy as collateral. We'll define it in more depth further into the lecture, but I want to spend some extra time on this because it's a relatively new concept in the history, shall we say, the contemporary history of the marketing of life insurance built for banking, of the infinite banking concept. And I have more and more clients who are asking what I think about them. And so I'm going to share that with you. And then we'll talk about what some of the long-term implications could be for your passive cash flow late in life, in the context of having a policy that receives direct recognition or non-direct recognition. And so one of the elements motivating company selection, meaning choosing the insurance company, choosing the mutual insurance company that you're going to buy dividend-paying whole life insurance from, has to do with this subject of non-direct versus direct recognition. So let's get into definitions and we'll expand. Okay, direct recognition. For a policy receiving direct recognition, the idea is that if the policy owner has a policy loan balance outstanding at the end of a policy year, the life insurance company reserves the right to reduce the dividend paid to that policy owner, to that policy, at the end of that policy year. Okay, so for a policy receiving direct recognition, the company can reduce the dividend. This is the main idea, right? Recognition treatment involves whether or not the dividend paid to a policy owner will be affected in the event that the policy owner has a policy loan balance, an indebtedness to the life insurance company. For direct recognition contracts, and by the way, I've used the term contract and policy interchangeably. A life insurance policy is a contract, so it's just a type of contract. So forgive me if that terminology is confusing, but in my view, that's what it is. So that's what I'm going to call it. A direct recognition treated contract for a contract treated with direct recognition, a company reserves the right to reduce the dividend. For a policy receiving non-direct recognition treatment, that is not the case. Okay, if an individual has a policy that's treated with non-direct recognition, then if they have a policy loan balance outstanding at the end of their policy year, the life insurance company is going to pay the same dividend they would have paid anyway, even if that individual did not have a policy loan balance outstanding. Okay, so there's your difference. Now, if you'll remember, again, this lecture series is intended to be watched sequentially. In our last lecture on non-forfeiture options and policy loans, we discussed that direct recognition companies, for policies receiving direct recognition, the policy loan interest rate regime, so policy loan interest rate regime is typically fixed, right? Companies will offer policy loans at fixed interest rates, whereas for policies receiving non-direct recognition treatment, the policy loan rate regime is typically variable. Okay, so in your different companies won't just say this policy receives direct recognition treatment. No. What they will typically say, what you'll find on the illustration, what you'll find in the contract, is this language. Loans, for direct recognition, loans affect dividends. Right, affect. Sort of an ambiguous term. It's like loans affect dividends. Well, if I take a loan, will I get a bigger dividend? No. If you take a policy loan and the loan indebtedness is outstanding at the end of the policy year, then with a direct recognition treated contract, the way the loan affects the dividend is by reducing it. Okay, so that's the language you'll often see for direct recognition. And then similarly for non-direct recognition policies, you might see language like loans do not affect dividends. Okay. So they won't just come out and say direct or non-direct recognition. You have to decode some of the language sometimes, well, many times with life insurance companies. All right, and notice the terminology I've been using. I'm trying to be careful and refer to a policy that is treated with or a policy that receives a certain kind of recognition, either direct or non-direct. You'll hear online the idea of a non-direct or a direct recognition company as well. So notice the difference: a direct versus non-direct recognition policy versus a direct or non-direct recognition company. Now, the idea of using the term company in there is, it's kind of similar to when we say that cash value is the collateral on policy loans. It's like, not really. The collateral on a policy loan is the death benefit, but close enough. We know what you mean, right? The cash value is what the death benefit is worth today. So when and the amount of cash value you have, your equity in the contract governs how much of a policy loan you can get. So to say that the collateral on policy loans is cash value is like indirectly true. It's good enough in a sense. It's very similar in this regard. When we refer to, say, a direct recognition company, what we mean is a company that only treats policies with direct recognition. Okay, and so a non-direct recognition company would be one where for all the contracts, all the policies they offer, all of those contracts are treated with non-direct recognition. Okay, but the reason I distinguish between talking about a direct recognition company or a non-direct recognition company versus a certain kind of policy is that some companies have started to offer either, meaning that a policy owner will get to choose, right, whether I want to have direct recognition or non-direct recognition. Now, whether there's value in getting to make the choice, hey, we all want more choices, no question. This is just one element that goes into this idea of company selection, but if a company allows the customer to choose between one or the other, then we can't really refer to the company as either direct or non-direct. Right, so I'm going to do my best, and I'm sure I'll screw it up, but we want to refer to a policy as either receiving direct or non-direct recognition. Little digression here to sort of understand my point of view on this. I've mentioned before in, I think it was the policy infrastructure lecture in our brief introduction to dividend. Well, it was in a previous lecture, let's say that, where we briefly touched on dividends. That a dividend is, economically speaking, compensation for ownership. Okay, if you have a share of a publicly traded stock and that company pays dividends, and it's a share of stock that entitles you to a dividend, then the idea is that the company is paying you for your ownership in that firm, right? Because you paid them money, you got your little piece of paper or digital email, essentially, that is entitling you to a share of the ownership of that firm. a share of the financial surplus of that firm because of your ownership, right? So that's what a dividend is. Interest, in contrast, is the price of credit. Okay, so let's think of an example. Home Depot, a publicly traded company. Home Depot happens to offer consumer credit cards, right? So Home Depot has a financing arm, and they'll allow you to go and you can get one of their little credit cards. You go buy something from Home Depot. You might purchase it on credit using the Home Depot credit card or Home Depot consumer credit card. Now, Home Depot is also publicly traded, and so you could theoretically be somebody who owns stock in Home Depot and who shops at Home Depot and who has their consumer credit card. Okay, so imagine if you're one of those people, and let's assume, I don't know if Home Depot does pay dividends on their stock. Let's assume they do. Most publicly traded companies don't pay much dividends anymore, but follow me here. Let's assume you go to Home Depot. You're going to buy your washing machine or what have you on consumer credit. And then at the end of the fiscal year, when Home Depot decides what dividends to pay out to shareholders, they say, well, Mr. Joe or Mr. Jane or Mrs. Jane had, they used consumer credit that we offered them this year to go purchase their washing machine. So we're going to reduce how much we pay them in dividend. Yeah, no, first of all, that doesn't happen. And if it did, there'd be a shareholder revolt. It would be like essentially saying that shareholders in Home Depot are penalized for being consumers at the business, which is kind of silly, because why would the CEO, the executive staff, the majority shareholder, the larger shareholders, why would they want to penalize owners of the company for contributing to the revenue of the company? Like, wouldn't we want everybody, as many people to shop at Home Depot and utilize all their services, including their very profitable financing arm, as much as possible? Wouldn't that increase our revenue? Isn't, hypothetically, share price a function of revenue? Well, yeah, hypothetically. Of course, share prices have drifted far away from old school valuation principles, but that's beside the point. The idea is that, of course, we'd want, as owners, as participants in the financial surplus of a particular entity, of course we would want our co-owners to contribute to the revenue of the business. Right? Why would we penalize them for that? Well, in life insurance, this is called direct recognition. Look, I can come across kind of tough on things. I get it. If there were only direct recognition companies, if all we had were policies treated with direct recognition to buy and sell, then that's what I would buy and sell. But that's not the case. Because to me, it's economically incoherent. A dividend is compensation for ownership. I'm a member of a mutual enterprise. By virtue of being a customer, I am entitled to my share of the financial surplus generated by the organization. Now, if I, as both customer and residual claimant, economic terminology, if I as both customer and that's what it is, a residual claim, but somebody who has a contractual right to the financial surplus, if I'm both of those individuals and I decide to exercise my rights, my authority granted to me by the contract I purchased in my capacity as a consumer, why then would I be penalized when it comes time for me to participate in the financial surplus? It's as if I have to pay twice. I'm paying once in the form of interest, and loans are loans. Loans have interest. I got to pay interest for the loan. Okay, that's what it is. As we talked about in the last lecture, policy loans are the most efficient credit instrument on the planet. I'm okay paying interest on those policy loans. In fact, interest is revenue to the company, and I'm a member of a mutual enterprise. That company is going to pay me a dividend. Whenever I pay interest I'm contributing to the revenue of an entity that's going to pay me a dividend. You know, if you're a business owner, some of you agents watching, you're business owners, many of you clients, both current clients of mine and others watching, you might be a business owner. It's okay to contribute to the revenue of your own firm, right? Go back to the grocery store in becoming your own banker. You got two options. You can walk out the front door with your can of peas. You can walk out the back door with the can of peas. Nelson says, by gosh, you ought to walk out the front door. In fact, you should pay more. Right? Thereby contributing to the revenue of the business that you own. Right? So it's okay to contribute to the revenue of an entity that's going to pay you a dividend. That's fine. So I don't have a problem paying interest. I don't want to, my payment of interest to the company, of pure policy loan interest to the company, is not going to affect my cash value. Just because I make a policy loan repayment and make an interest payment to the company, that's not going to increase my cash value. Don't get me wrong. But I am indirectly supporting my own dividend. Right? So it's, I don't gain in terms of value generation in the contract per se at that time. But it's much better than, say, paying interest to an entity that I don't have an ownership position in. Right? So I don't have a problem with interest. But at the same time, I would also like for my dividend to be as high as it can be. Remember, the default dividend election is PUA premium. I'd like all of that dividend to go back into my policy in the form of PUA to buy more death benefit and generate more cash value. So in fact, there's even a sense in which, like, if I'm taking policy loans and I'm paying interest, and I'm contributing to the revenue of a company which is going to pay me a dividend, and therefore I'm indirectly contributing to my own dividend. How could it possibly make economic sense to go through that process, to take a loan, to repay the loan, to pay the interest, and then be penalized for doing that? That doesn't make economic sense to me. But here are some of the reasons given for why that could be acceptable. And again, I got to add the caveat. If direct recognition policies were all we had, look, I can imagine a world in the future where all policies are treated with direct recognition. And if that were the case, look, dividend-paying whole life insurance is still the best place to put money. It's still the ideal warehouse, what Nelson called your warehouse of wealth. IBC would still be the ideal capitalization strategy. But given that we have the option, I take a position. That said, here are some of the reasons given for the use of direct recognition. The first one is like, well, it's neither here nor there. 6 in one hand, half a dozen in the other. Right? And besides, direct recognition companies generate better investment revenue. Well, first of all, I'm waiting on the evidence for that. That it certainly doesn't make any economic sense, right? If a company happened to have, if a life insurance company happened to have highly skilled investment managers with a great network, and they really were able to find better uses for the investable funds of the company, okay, great. But that's not going to last forever, right? Either somebody else is going to find out about those other opportunities, and the return will be bid down to equilibrium, we could say. Or if the investment manager is intelligent, he's saying, look, I'm bringing you guys outsized returns. I want to be paid a little more. Okay, in other words, there are market forces at work to eliminate this idea of special knowledge, of special lasting knowledge of exceptional investment opportunities. So I could it be the case that in a given year a company has an investment manager that's able to invest funds better, and that company happens to offer direct recognition treatment on policies? Sure. Is that going to last? Show me some evidence for that to be. I would need to see some evidence for that to be the case. Right, but this first idea that direct recognition companies generate better investment revenue has a bit to do with this second point. Right, this second rationalization is, well, the policy owners who don't take policy loans, they might say, well, look, the policy owners who are borrowing money they deserve the lower dividend because they're taking policy loans. And if other policy owners take policy loans, then they're accessing the investable funds at the company, and consequently, the company doesn't have as much in investable funds to go out and generate investment revenue elsewhere in the market. And therefore, ostensibly, our dividends will be affected, right? The dividends for those of us who aren't borrowing, who aren't taking away from the available investment capital in a given year, we're suffering because our dividends are going to be lower. I've heard that one before. And it's like, so, it's only fair. always an appeal to equity, a different kind of equity than what we've been talking about here. But it's an appeal to fairness. Like it's only right that those borrowing policy owners receive a lower dividend. That way, we can offset the ostensible losses that we non-borrowing policy owners suffer because those other borrowing policy owners are shifting away investable funds from what the investment managers otherwise could be doing. Okay, the problem with that idea is that policy loans are investments. Ask your agent to ask their regional vice president to ask the executive officers at the company, where do policy loans appear on the balance sheet of a life insurance company? And they will tell you that they're on the asset side of the ledger, under the investable account, or whatever the company happens to call it. And we've touched on this in the non-forfeiture option and policy loan lecture. A policy loan is an account receivable to the company. Now, a variation of this that I heard very recently is that the companies will say, well, the one issue with policy loans is that the borrower has full control over the note, which is great for us. But the one possible concern for the life insurance company is that, well, we as the company don't have a clear idea of the timing of repayment. Okay, we don't know when that interest income in the form of policy loan interest payment, we don't know when that money's going to come in. We don't know when we're going to get the principal back either, right? Because the policy owner controls the note. To which I say, so what? First of all, the life insurance companies set the interest rates. Understand, y'all, that when you go to get one of these policies, the contract's written. Okay, there's a committee at the company. They're revised every so often, but it's essentially a template. And you're going to have what's called a data page for that policy, and it's going to specify all the particular information that pertains to you. Okay, but all the definitions and things like interest rates, all that is predefined, but determined by the company before you bought the policy. In fact, the policies aren't even offered on the market until all that stuff's decided. Okay, so the company's choosing the interest rate regime. They're choosing whether to offer fixed or variable rates, and they're choosing what those numbers are. Look, even if the companies offer a fixed interest rate regime on loans, it can be a higher number, right? They're choosing that. So if I'm a life insurance company and I'm really, truly so fearful that the sequence of repayment, that the timing of policy loan repayment is so variable, so uncertain that it's really affecting my available investable capital, it's really affecting my ability as a company to go and get the returns I need to support my liabilities, to support the guarantees I've made in the form of death benefits and cash values. If I'm truly worried about that, well, then raise the interest rates. So I don't buy that. I don't buy that you're going to complain about the timing of repayment when you set the terms. Right? You set the terms of what it means to take a policy loan, what it means to repay a policy loan. So there's one slight variation that policy loan borrowers introduce unpredictable timing of investment revenue. You might summarize it that way. It's like, yeah, I don't buy that either. By the way, these companies have some of the best actuaries in the world who are responsible for analyzing statistics across tens of thousands of people, of customers. And so just like they perform actuarial analysis to determine mortality and, well, essentially mortality, they could perform the same kind of analysis to determine the general average, shall we say, overall frequency across policy owners of loan repayment. And they could use that information to essentially price their loans. So I don't buy that either. That one's not. That one actually I heard from a life insurance company executive. I don't think there's many agents out there saying that kind of stuff, but if there are, you're already prepared. All right, this third one is one I've heard more often, and it's kind of presented as like a clever thing. And this one bothers me a bit because it directly violates one of Nelson Nash's rules, which was don't do business with banks. So we're going to do IBC. We're going to do what Nelson Nash taught. But the way I'm going to advise clients to go and do that is in direct violation of one of the 5 rules Nelson laid out. I don't like that. And then, so there's a theoretical, philosophical problem I have with it. You might share it, you might not. But that's just where I'm coming from. But then there's also other problems with these cash value lines of credit. Okay, so the overall idea is, look, if you've got a policy from a direct recognition company, we acknowledge that, in a sense, this is like an objection following sort of a retreat, right? Look, we acknowledge that if you take a policy loan and that loan is outstanding at the end of the year, that you're going to receive a lower dividend than you otherwise would. We get it, and that's bad because the dividend's going in the form of PUA, and that's supporting your ongoing death benefit and cash value growth, and we get that we wouldn't want that. So rather than taking a policy loan from a life insurance company when you want to leverage your cash value, instead, go open a line of credit at a bank and use your policy as collateral. In other words, rather than collateralizing your cash value, collateralizing your death benefit with the life insurance company, instead, go do that with a commercial bank. It's called a cash value line of credit. And so I've had a few clients ask me about this. I've actually looked at some of the banks. You can Google this, cash value line of credit. The few sort of obscure banks that offer it will. Not that there's anything wrong with the banks per se, but the ones I've seen happen to be relatively small and sort of unknown. At least I hadn't seen the names before. You can Google them and find them. As I said, this violates Nelson's rule number 4, like on purpose. These cash value lines of credit are always advertised with a lower nominal rate of interest than policy loans. So if the company says, look, our rate on policy loans is 5%, the commercial bank might say, well, our rate on a cash value line of credit is 3.75. And don't you know, 3.75 is a lower number than 5. Therefore, what are you doing? Come borrow from us. Don't borrow from the company. Right? Getting back to that idea that I mentioned before, that a lot of what passes as financial analysis now is telling the difference between the magnitude of numbers. It's like, yeah, I get that 3.75 is lower than 5. However, an unstructured conventional line of credit, including a cash value line of credit, has monthly interest compounding. Again, this is why this course is sequential. Recall that with policy loans, interest accrues daily, loan repayments go 100% to principal, and the only time that interest is added to the balance is one time per year at the end of the policy year. So interest compounds onto the balance once per year. In unstructured lines of credit, meaning lines of credit without a specified duration, right, a specified repayment duration, interest always compounds monthly, 12 times per year instead of once. We go back to Nelson. It's not about the rate. It's about the volume. And if we have monthly compounding, we will end up with a higher volume of interest, expressed as a percentage of the principal than the nominal rate would suggest. Okay, I said this on a prior lecture that if you were to count the number of dollars paid in interest on a policy loan for a given year and divide that number into the principal on the note, right, what you originally borrowed, and multiply by 100%, you would get a sort of a real rate of interest by volume that is lower than the nominal rate, right? So long as you make loan repayments during the year. In conventional unstructured credit, the opposite is true. If you were to count the number of interest dollars paid throughout the time that that the amount borrowed was outstanding, take those dollars, divide that into the initial principal that you borrowed, multiply by 100%, the number will be greater than what the nominal quoted rate was. And the reason is the frequency of compounding. I think that bankers just don't know that. They think that their spec sheet, their marketing sheet, their scripts say our loans have lower rates than policy loans, therefore go market this thing. I think they have the best intentions. I'm willing to believe that. But if we take into account the frequency of compounding, we'll see that this claim is not as favorable in for cash value lines of credit as one might think. That's problem number 2. Problem number 3, look, with life insurance companies, there's this idea of like incrementally perfect collateralization, right? If let's say I've got a death benefit of $1 million, I've got cash value of $200,000, I go to take a $50,000 policy loan. Well, the collateral on that $50,000 policy loan on day one is $50,000 of the $1 million of death benefit. Right? The collateral exactly matches the $50,000 of death benefit, exactly matches the $50,000 of policy loan amount. In conventional banking, again, the opposite is true. If you go get a cash value line of credit, same policy, $1 million in death benefit, $200,000 in cash value, you want to get a $50,000 loan. You go to a commercial bank, say, I want a cash value line of credit. The company's going to say, okay, we need a letter from the life insurance company granting us a collateral assignment over the entire contract. The full $1 million. Remember that concept of over collateralization we talked about? Over collateralization. Collateralization spelling, y'all, is not my forte here. Over collateralization, the idea that the bank wants to have collateral, the value of which is greater than what they've loaned out. It's always the case. It's always the case. Why? Those with the gold make the rules. So they can do it. By the way, if you were lending money to somebody and you had the ability to require a collateral assignment, wouldn't you want the value of the collateral to exceed what you were borrowing? That way, if the borrower repaid, great, you win. If the borrower doesn't repay, great, you also win. Because the value of the property you repossess is greater than what you lent out. Talk about a win-win situation. Banks do the same thing. And it's especially true in cash value lines of credit. The companies want a total collateral. So I was talking about this with James once, and he's like, back when we used to put things on paper, the lender at the commercial bank would want the physical paper policy in the desk drawer or in the vault or wherever they keep them. Like the whole contract. And can you imagine if a banker understood, and maybe these bankers do understand the power in cash value life insurance, the effect of compounding over time. What banker wouldn't want to take ownership over an asset like that? Right? So to specify the implications here, look, if you don't repay the policy loan for your lifetime and you go and you pass away, the consequence will be an exact deduction. The amount of the loan balance outstanding will be deducted from the death benefit. The rest of the death benefit which was not collateralized, goes to beneficiaries. Now, in the context of conventional banking, if you violate whatever the terms are, you fall out of favor, or maybe the bank that gave you the cash value line of credit got bought out, and the new bank doesn't like this kind of business, so they call all the loans due, right? For whatever reason, we can assume that you fall out of favor with the particular company or violate the terms of the agreement or what have you. Technically speaking, they have a collateral assignment. They have an ownership claim to the entire contract. No thanks. No thanks. I've made the point in the past, this is becoming your own banker. This isn't becoming a banker so that you can go become subservient to another banker. And then, thinking long range, what happens late in life? We've kind of started to talk some about what happens to cash value way down the line in the life of one of these policies. The growth is compounded. You're contributing with your PUA premium payment. Time is going by. Ultimately, remember those 4 growth factors of cash value, lecture number 2? Right? All those 4 things: payment of base premium, PUA out of your own pocket, PUA from the dividend, and the passage of time. I think I said all 4. Did I repeat one? Maybe the payment of base premium. Over time, we produce a compounding growth effect. The growth in cash value long-term is going to be tremendous. Okay, well, maybe I'd like some passive tax-free cash flow late in life. Well, if you have a policy from a non-direct recognition company, you might say, well, look, maybe I'll just take a policy loan each year and use that as passive tax-free cash flow. It's not income. It's not income. Income's taxable. Loans are loans. Loans are not taxable. So maybe I take a policy loan each year to go do what I want. And I might like to decide how much I want each year. One year I might travel. One year I might spend more time with the family. One year I might pick up a hobby. Whatever it is. Okay, well, late in the life of these policies, in order to preserve the non-MEC status, your out-of-pocket PUA premium payment will go down. Eventually, the PUA rider will fall off the policy. Okay, and the only thing paid into the contract will be base premium. Okay, so no longer are your out-of-pocket PUA premium payments contributing to the ongoing cash value growth. We've lost one of the 4 factors. The other 3, passage of time, payment of base premium, and PUA from the dividend, those 3 factors are still contributing to your ongoing growth, no question. Okay, but my ability to contribute directly in the magnitude I was with my prior PUA payments, that's now shut off because I want to preserve that non-MEC treatment. Well, it turns out that the dividend is responsible for a substantial portion of annual cash value growth late in the life of these policies. And depending upon how long the policy was in force, depending upon how much premium you paid, the percentage could be anywhere from 25 to 50% or even more of the annual cash value growth. Okay, especially since Rule 7702 change in late 2020, early 2021. Not going to get into that here. But my point is, late into the life of a policy, PUA from the dividend is responsible for a lot of the ongoing cash value growth. PUA from the dividend. Okay, well, if I'm going to start taking policy loans every year to have some passive tax-free cash flow with maybe no intention of repaying them back, knowing full well that if I pass away with a loan balance outstanding, that's going to be reduced from my death benefit. I get that. I mean, the beneficiaries are going to get more than they would have ever gotten otherwise. So maybe I'd like to use some of that capital to enjoy my time late in life. Might even like to use that capital while I'm living for the benefit of my people. Well, if I start running a policy loan balance each year, and in fact a rising one at that, and I have got a policy with a direct recognition company, well, what's going to happen to my dividend? It'll go down. And one of those major contributors to cash value will be diluted. Now, I'm not saying all companies are like this, but there are some companies where in order to maintain a consecutive track record of dividend payment, they'll pay a dividend, but it might as well be zero. I mean, it's positive. It's a positive number. But if they're direct recognition, they've got the ability to lower the dividend scale for you because you have a policy loan balance outstanding. In fact, a growing one. In fact, the degree of reduction in the dividend may be related to the magnitude of your loan balance. Different companies have different practices. I'm not saying this is how it is across the board. I'm just saying, how much of that do I want? Relatively speaking, would I like for my dividend to remain preserved, to maximize the amount of PUA that's coming from that dividend to go into my policy in the form of PUA to increase death benefit and increase cash value? Or am I okay with an unknown reduction in the magnitude of that dividend and therefore the PUA premium? All else equal, y'all, I prefer to pay the same dividend that you were going to pay me anyway. Going back to the Home Depot example, maybe I'm a Home Depot contractor, right? Or I sell appliances, or I shop a lot at Home Depot, and I use that consumer credit card or that business credit card a lot at Home Depot. But I'm also a shareholder of Home Depot. Would it make sense for Home Depot to continually lower my residual claimancy, my share in the financial surplus, my dividend, because I'm an avid consumer at the company? No. I can't find a way around that. If y'all can, listen, leave a comment and tell me about it. They're moderated. No, seriously. I mean, if someone can find a way out of that line of thinking, I would really like to know about it. And I'll fall on the sword. I'll correct myself. But so far, I can't see it. This is kind of a summary slide of what I just went through. Look, leave my damn dividend alone. Pretty simple. Leave it alone. If direct recognition policies were all we had, so be it. We'll sell policies that receive direct recognition treatment. Not the end of the world. Where else can you get guaranteed compounded cash value growth for the rest of your life with contractual guaranteed access on your terms via policy loan? Nowhere. Remember, even a modified endowment contract's not the end of the world. Of course, we're going to involve Uncle Sam, and he gets plenty as it is, so no need to do that. Similar thing here. There's no need, in my view. Not the end of the world. Neither is pineapple on pizza. That doesn't mean I go buy it. I think there are some legitimate long-term future cash flows. In the least, y'all, we introduce some uncertainty into the cash value growth late in the life of the contract. Every illustration in Becoming Your Own Banker shows passive cash flow late in life. I talk a lot about capital and the use of capital. One of the most common pervasive uses of capital is the provision of so-called retirement income or passive late life cash flow. So we all share that. Right? We're all, maybe you're blessed. Maybe there's going to be plenty of money hanging around. You don't need any other cash flow from any other asset late in life. If that's you, bravo, you did a good job. Me, and I think a lot of us might like to have, at least we'd like the authority to access some passive cash flow late in life. And in the event that we do, I'd like the availability of that cash flow to be as high as possible. And so if we introduce some uncertainty into one of the things that's responsible for that growth late in life, well, if I'm able, I'd like to get rid of that uncertainty. By the way, most often, a policy, like I said earlier, a policy is treated either with direct or non-direct recognition. Only at a few companies can you change it. So it's not like you can switch it up later on. That's why, in my opinion, this matters when you're going to go get a policy to implement infinite banking. And look, if you have, and I have clients like this, by the way, if you're an agent listening, you have clients, or if you're an individual and you have policies that are treated with direct recognition, okay, not the end of the world. I'm not saying you should go replace it tomorrow. I'm not trying to make you feel bad. But I think these are legitimate concerns to consider. And as you go about expanding your system, maybe you consider non-direct recognition in the future. Right? It's not like there won't be any cash value growth late in the life of the contract. Here's the implication. If you have a well-funded direct recognition policy and you get to late in life and you're going to start to take passive cash flow, and maybe now you've become aware of the impact on the dividend and what that could mean for your cash value growth, the way to manage that is to just take less in policy loans. Right? Keep your loan balance relative lower than what it otherwise would have been. And watch it. Right? Read the annual report. Look at what the dividend is paid to you at the end of the year compared to what was originally illustrated, and you have a good approximation of the dividend penalty. So keep that in mind. Right? Be like, well, can I do this next year? Can I do it the year after? How much do we really need? You know, and remember, there's other ways to get to cash value. You could partial surrender. Now, theoretically, that involves some of the same problems, right? Go back to the non-forfeiture option lecture. That's going to involve a reduction in death benefit and a gross reduction in cash value. But just be conscious of it. Look, in the illustrations in Becoming Your Own Banker, the passive cash flow late in life in all those scenarios is assumed to be funded via partial surrender or premium offset, a combination of dividend, a change in the dividend election, and a partial surrender. But then look at the very bottom line, net annual outlay at the end of those illustrations. I'm thinking particularly of equipment financing. And the amount received late in life is way more than what the individual paid in premium. It is not the end of the world if the policy you have is treated with direct recognition. It can be managed, and things will still work out better for you than they otherwise would have if you had never bought life insurance built for banking in the first place. Again, calibration, optimization. And I'm only telling y'all about this, one, because it's out there, but two, because I get questions on this. And remember, like I said, it has to do with the idea of company selection. You know, do I want to get a policy from a company where all their policies are treated with direct recognition? Or do I just want to make sure that my policy receives non-direct recognition? And by the way, whole life insurance contracts are unilateral contracts. The company, once the policy is in force, it receives non-direct or direct recognition. The company can't change their mind in the future. You can't start off with a non-direct recognition treated contract and then the company 10 years later say, well, never mind. No. You have a contractual right to your full share of the financial surplus generated by that company. So my point here is that there's a degree of permanency to this. I'll say this here, a little added, obviously that's not on the slide, but you should be aware of it. There are some companies that will say, look, you have a choice between direct recognition and non-direct recognition. But if you choose direct recognition, then we'll allow you to index your dividend. Remember the lecture on modified endowment contracts and term riders? We talked about blended term PUA riders, and that some companies offer these riders where the dividend is assumed to pay the premium, and that some companies also offer those riders and then they also index the dividend. Okay, that's not the only scenario where a company might offer to index the dividend. Okay, this dividend index option can be offered in multiple contexts. And one of them I've noticed is this. Look, you can choose direct recognition or non-direct recognition, but look at what the market's done. Wouldn't you want to experience or enjoy some of the benefit of that market that rises forever and ever, every year indefinitely? Look, index your dividend. Now, if you do so, we're going to treat your policy with direct recognition, which means if you take loans, then we're going to reduce that dividend that you indexed. But hey, don't take loans, and then it's fine. And look, I have my people catch the flu every now and then, or they might catch a cold. I catch bouts of skepticism every so often. And sometimes it's like, why would all these things be introduced to increase the cost that I have to pay in order to access capital that I have contractual control over? Could it be that, Well, maybe the company doesn't want me to use that capital. Maybe the company wants to use it themselves. Okay. I mean, look, again, not the end of the world, but I don't like it. Leave the dividend alone. Don't index it. My opinion, don't index it, and don't decrease it. And also don't index it and don't decrease it. Obviously, we didn't spend much time on the indexing of dividends here. It's kind of a digression, but you can tell how I feel. Remember, all riders have a cost. And so, yeah, the dividend might be indexed, and there might be a floor. You know, we're not going to decrease the dividend just because you index it. Yeah, okay, but the rider has a cost. Who's paying for that? Oh, am I? Okay. As always, whether you agree with me or not, I would like for you to understand your policy's recognition treatment. And remember, the language you're looking for is whether or not loans affect dividends. If loans affect dividends, direct recognition. If loans do not affect dividends, non-direct recognition. You made it. That wasn't so bad. Prior lecture's been over an hour. This one's only 51 minutes. Look, next time we're getting into case studies. You've earned it. You've put in the effort. You've made it here with me so far. We're going to apply everything we've learned over the last several lectures with examples. The next one's going to be a big one. We're going to cover a lot. We're going to look at text that I've taken from particular illustrations, from illustrations regarding policies that some of my clients have acquired from other agents in the past. We're going to look at bar charts where I show you cash value growth over time for policies that I think could have been built better versus how I would have done a contract. I mean, we're going to go in. We'll address we'll get in particular this idea of 1090. 1090 is everywhere. Sort of fits in with the idea that there's a one-size-fits-all structure, that everywhere and always is a good idea. Wrong. But we'll look at two examples of them. One of them has a blended term PUA rider on it. We'll look at the particular language for that blended term PUA rider. I've mentioned in passing in the past that various PUA riders have terms and conditions that vary quite a bit company to company and contract to contract. So we're going to look at one relatively inflexible PUA rider and what that actually is. Just an example of what that means, what that inflexibility means for a particular rider. We'll talk about long versus short-dated level term. If you go back to the term rider and modified endowment contract lecture, we talked about, we just mentioned briefly some of what I'm seeing that oftentimes we're, in my opinion, using too little term, too insufficiently long-dated term, let's say. We'll compare some of what we look at to what I would have done differently, both in terms of the quality of the ability, the quality of the individual's contractual authority to pay premium, and in terms of illustrated cash value growth. And we've mentioned the perfect premium structure myth. All right. Thanks for listening, y'all. We'll see you next time.